Okay, hi everyone. This is Dr. Wright here. Our topic today is basic return concepts, as you can see on the screen. Let's jump right into this thing and see if we can get through it as efficiently as possible. Here is our threshold question in today's presentation. How should we assess investment performance, specifically portfolio investment performance? So what we're talking about is actively managed portfolios, somebody that's putting together a portfolio of stocks with the intent probably of beating the market, but we want to know how we should think about assessing the investment performance of a portfolio that is actively managed. Let's jump right into it. Here is WAMCX. This is a mutual fund managed by Wasatch Advisors. This is a 10-year history from 2010, January 1st of 2010, going through December 31st of 2019. So we have a 10-year period here. And what it shows you is if you started with $10,000 over that 10-year period, it would increase to $47,785.03. So our threshold question is, how should we think about this particular performance? Well, going from $10,000 to $47,785 in 10 years feels very impressive, but if that's all you did is you looked at a graph on a screen, that would be a very naive approach to trying to understand whether or not we should think about this performance as impressive or subpar. Maybe the next thing you would say is, well, how does it compare to the market? And you can see the answer to that question right here. The blue line, again, is WAMCX, the Wasatch Advisors Mutual Fund that we're focusing on. The red line is the S&P 500. You can see that over the course of the 10 years that I have here from 2010 to 2019, you can see that this Wasatch Advisors, and this is a small cap fund, by the way, this Wasatch Advisors small cap fund really eclipsed the S&P 500 by quite a wide margin. So just looking at this, you would think, wow, impressive. And this is one way to think about assessing investment performance, but you might want even more information. Well, here is the annual return for 2010 through 2019. It also shows you as a comparison to the category that it's in and the index. So notice that here, right here, in this top line or this top row, this is the return to the mutual fund relative to the category, relative to the index or the benchmark. Notice especially that the last 5 years, this fund has been going gangbusters, looking really good compared to its category and compared to the index. Okay, great. We're adding more information, and with every layer of information that we add, we're getting a better feel for how well this particular fund performed. But I want to pose this question: how should we think about portfolio returns? Should we simply look at a graph? Should we add a little bit of data? How should we really conceptualize total returns to an actively managed portfolio? And I want to propose a very simple decomposition. We could get into the weeds on this, but I'm going to keep us at a high level. We could think about total returns to an actively managed portfolio of deriving from 4 sources. One of those in the bottom left here in the southwest quadrant would be the risk-free return. Whatever the asset is in the economy that represents a riskless asset, then we would hope that an actively managed portfolio would at least earn that. And so what we're saying is part of the total return to an actively managed portfolio really can simply be attributed to whatever the risk-free rate is in the economy. That's part of it. If you look in the northwest quadrant, risk also should be a part of the story. So we believe that one of the fundamental principles of investing and finance and economics is that risk requires compensation. Therefore, in the long run, on average, somebody who takes on higher risk should have higher average returns. How does that translate into this decomposition of total returns for an actively managed portfolio? Well, what we're saying is some part of the returns that we're seeing are simply compensation for risk, right? So if we just focus on the western half of the pie, what we're saying is if you look at the total returns to an actively managed portfolio, some of that can be attributed simply to the risk-free rate. Some of it can be attributed to the risk that the portfolio manager is taking. But now focus on the eastern half of the pie here on the right side. We could also say that some of the returns might be attributable to acumen, investor acumen, the skill of the portfolio manager. Further, we have to acknowledge that some element, some component of the total returns to an actively managed portfolio have to be attributed to luck. Now, I don't mean for this pie to be scaled correctly. It could be that there's zero acumen, zero luck, and it's all just risk-free rate and risk. There could be elements of acumen. There could be elements of luck. Again, this isn't to scale. I'm just saying this is how we could think about decomposing the total returns to an actively managed portfolio. Well, we can come back here to this comparison that I showed you just a couple minutes ago. Again, this is this Wasatch Advisor small cap fund that we're looking at, WAMCX. And it looks over the last 10 years, or at least this 10-year period from 2010 to 2019, as though this particular portfolio, this mutual fund, really obliterated the S&P 500. I'm comparing it to SPY, which is the ETF that tracks the S&P 500. But the question is, how much of this is risk-free rate? How much of this is risk? How much of this is investor acumen? How much of this is luck? Well, in a perfect world, we would be able to precisely disentangle and decompose total returns into each of these four variables. So in a perfect world, we would have some mechanism, some tool that would allow us to identify precisely how much of the returns are coming from acumen. And we will try to do that, but here's a little bit of a preview. When we get into models that are actually trying to identify how much of the portfolio returns can be attributed to acumen, we're not going to be able to disentangle acumen from luck. So even when we get to that point, which is not going to happen in this video, that's going to be a separate video, but just remember that when we do get there to the models that we wish would be able to decompose and tell us exactly how much of the returns are coming from acumen, we're still not going to be able to disentangle acumen from luck, and that's really important. So if we can't perfectly and precisely pinpoint acumen, then let's think about a different way of assessing performance. Here's one way to think about it. So we're looking at WAMCX. Maybe what we want is we want some measure of the average returns to WAMCX, and we want to scale that by the risk that the portfolio manager has assumed inside of WAMCX. So this is like a return for every unit of risk measure. Obviously, as an investor, we want the numerator to be as high as possible. We want the denominator to be as low as possible. We want the most amount of return for every unit of risk that we take. And then we could compare this to a benchmark, to an alternative investment in the same category, or maybe this is the S&P 500. We have to be thoughtful about the benchmark. But if we do it this way, what it would tell us is on the left side, how much return is this portfolio manager generating per every unit of risk that she or he takes relative to an alternative investment or the benchmark. What you would want, or what would be a signal of potential investor acumen, but again, we're not going to be able to disentangle acumen from luck. Let's remember that. But what we would want is we would want a portfolio manager that seems to consistently deliver high returns relative to risk. Well, this is going to be our goal for the rest of the presentation today. If the graphics help you, this is how you can think about it. We're going to be looking at the total returns generated by the portfolio manager. We're going to scale it by how much of that is attributable to risk. We're going to do the same thing for a benchmark, and this is how we're going to think about assessing performance when it comes to actively managed portfolios. But in order to get there, we've got to take a little bit of a digression. And that digression is, it's an exploration of the topic of probability distributions. Let's dive right into this thing. I want to put in front of you two investment alternatives. There's a red investment alternative and there's a green investment alternative. These are distributions, and we're going to talk more about distributions, but most of you already have exposure. So when you see these pictures, you kind of have a sense of how to interpret them. Notice that in the red investment portfolio, the average return is 10%. And it's the same for the green. They both have the same average returns of 10%. But notice that the green distribution is far more dispersed. You can have a lot higher returns than 10%, but you can also have a lot lower returns than 10%. But the red distribution is really tight around that midpoint. So my question to you is, which of these two investment alternatives with the same average return, one of them with a tight distribution, the other one with a broad or wide distribution, which one of these two would an investor prefer? Well, don't answer that yet. Let's dive into this a little bit. Let's talk for just a second about the basics of probability distributions. A probability distribution is a graphic depiction of the possible outcomes of a random variable on the x-axis. Don't freak out. I'm going to give you a very specific example in the next slide, so hang with me. But on the x-axis, it's the potential outcomes of a random variable. On the y-axis, it's the probability of each outcome. Couple of notes. If the probability of that particular outcome, so probability of x equals 1, that means that outcome is certain. If the probability of x equals 0, so if the probability of a particular outcome is 0, that means the outcome is an impossibility. The sum of all probabilities of all possible outcomes must equal 1. This is a rule of probability distributions. Further, the area under the distribution up to a certain possible outcome equals the probability of the outcome being equal to or less than that specific outcome. Let me show you some specifics here to help you get your mind around this. What I'm showing you on the screen here is the probability distributions of height for men and women in the United States at the latest reading. You can see from the graph that the average man in the United States of America is right around 5'10", just a little bit south of 5'10", and the average height for a woman in the United States is right around 5'4". What I want you to take away from this graph, though, is this is a probability distribution. On the x-axis, it shows you the possible outcomes of a random variable. In our case, what's the random variable? It is height. So we're showing you all of the possible outcomes on the x-axis. On the y-axis, we're showing you the probabilities of those potential outcomes. Now, every probability distribution can be defined by what we call the 4 moments. I don't know why we call it the 4 moments. I'm sorry, I didn't look that up, but we refer to them as the 4 moments. These are the 4 defining statistics that help you to draw any distribution. The first moment is the statistical mean. It is the average, otherwise known as the midpoint. So the first thing that helps you understand a probability distribution is the midpoint. For men, when it comes to height, the midpoint in America is just under 5'10". For women, it's almost right at 5'4". The second moment, the second key statistic to help you understand the shape of a distribution is the standard deviation. The standard deviation, by definition, is the average dispersion of the distribution around the midpoint. That's the second moment, standard deviation, average dispersion around the midpoint. The third moment is skewness, asymmetry. Are there any unbalanced tails? I'm showing you normal distributions right now, so you're not going to see any weird asymmetry. But in other distributions, you'll see wild asymmetry. Think about the distribution of annual income in the United States. That thing is going to skew like crazy to the right because it can't go below 0. So there will be a midpoint, then it will be truncated on the left, and then it's going to run like crazy to the right, so you would see skewness in that distribution. Okay, the fourth moment, the fourth defining statistic for any distribution is called kurtosis. This is the thickness of the tails. How fat are the tails? So we're talking about this area of the graph over here. Okay, so any distribution can be defined by these 4 moments: the midpoint, which is the statistical mean; the standard deviation, which is the average dispersion around the midpoint; skewness, which is the asymmetry, and kurtosis, which is the thickness of the tails. All right, normal distributions are nice and unique. Here's how normal distributions are nice and unique. Normal distributions are entirely defined by the first two moments. So all you need when you're defining a normal distribution is the mean and the standard deviation. This is because skewness will be 0. There is no asymmetry in a normal distribution, and kurtosis will always be constant at 3. Okay, so how do we calculate sample mean and standard deviation? Let's go through this real quickly. In order to get the mean, you can see the math right down here. And by the way, we refer to a sample mean usually as X bar, right? So a bar over the top of your random variable just signals that this is the mean, this is the sample mean. All you do is simply take each observation, add it up. That's what we've got going right here. So for every observation, just record it and add it up, and then divide that sum by the total number of observations. This is very easy math, and I'll give you an example here in just a second. Okay, how do we then calculate standard deviation? So the mean is easy. Standard deviation is a little bit more difficult, but before you look at the math, I want to remind you, the intuition behind standard deviation is super simple. Standard deviation, which is the second moment of the distribution, is simply the average dispersion around the midpoint. Average dispersion around the midpoint. So check it out. What you're going to do is you're going to take every observation and you're going to subtract the midpoint for every observation. Then you're going to square it. Once you've squared that dispersion of every observation, you're going to add that up. So you're going to have the sum of the squared dispersion around the mean. You're going to divide it by the number of observations minus 1. We're not going to get into why that is. Just trust me on it. You're going to divide it by the number of observations minus 1. If you just do that, you will have the average squared dispersion around the mean. So then, to get the average dispersion around the mean, you simply take the square root of that average squared dispersion. Let me give you a very concrete example here. I just listed all of the adult males in my immediate family and my in-laws. So I started out with myself and my 2 sons who have grown to maturity, my dad, my brothers, my brother-in-law, a nephew, father-in-law, and then 3 brothers-in-law. It's a small sample, only 13 people, and I just listed our height in inches. So I'm 5'7". One of my sons is 5'8". One of my sons is 6 feet. My dad is 5'8". I've got a brother that's 6'1", a brother that's 5'10", on down the list. Okay, so in order to get the average, which I want to remind you is the first moment, the midpoint of any distribution, all I did is I added up all of our heights. So I just added it up, and then I divided by the number of observations, which in this case was 13 men. When I do that, I get an average of 71 inches. So in our sample, we're slightly above. I know it's hard to believe because I'm short, but in this sample of my family, we're slightly above the national average. So the average here among these 13 men would be 5'11". That's pretty easy. Now I want to show you how to get standard deviation. Remember the first step, let's go back to our formula. The first step is for every observation, subtract out the midpoint, and then square it. So what I've done is I've taken every observation, subtracted the midpoint. That's right here. So that's the non-squared deviation. Then right here, I've squared it. So for every observation, I've found the deviation, I've squared it. Then I sum all of those squares. So right here, I have the sum of the squared deviations. Next step, divide by the number of observations minus 1. In this case, we have 13 observations, so I divide by 12. That is the average squared deviation. There's a name for that. It's called variance. But in order to get standard deviation, we have to take the square root of that. So if I take the square root of that, I get a standard deviation of 2.48. So what I have is a mean of 71 inches, 5'11", and a standard deviation of 2.48 inches. But how do we make sense of this? How does that become useful? And by the way, if you're getting a little bit bored, hang with me. I promise we're going to get back to portfolio returns and assessing performance in just a couple minutes here. But I want to show you something called the 68, 95, 99 rule, which says that in a normal distribution, if you start with the midpoint and go one standard deviation on either side, roughly 68% of all observations will fall within that range. If you take the midpoint and go two standard deviations on either side, roughly 95% of all observations will fall in that range. If you take the midpoint and go three standard deviations on either side, roughly 99% of all observations will fall within that range. So the average male height in the US is 70 inches with a standard deviation of 4 inches. What does the 68, 95, 99 rule tell us? Well, it tells us that let's just stick to the 99 rule. If we go three standard deviations on either side of the mean, which in this case, three standard deviations would be 12 inches, right? So the average height in the US is 70 inches, which is 5'10". If we go 1 foot on either side of that, 99% of all men are going to fall in that range. So that would be 4'10" to 6'10". So 99% of all men in the United States are between 4'10" and 6'10". Well, let's apply this to my little sample. Remember, I got an average of 71 inches and a standard deviation of 2.5 inches. So I just calculated my 99% bound, my range, by going three standard deviations below and three standard deviations above. And so according to my sample, men, 99% of men should be somewhere between 63.5 inches and 78.5 inches, which is a little bit tighter bound than what you get on the national average. Okay, that's just the basics of probability distributions, and we're not going to worry about skewness, and we're not going to worry about kurtosis. Moving back to how we started this conversation on probability distributions. So I presented you with two investment options. There was a red option and a green option. And in the red option, the average return was 10%. What I didn't tell you, but I'm telling you now, is that the standard deviation is 5%. With the green investment option, standard deviation is 10%, or sorry, the mean is 10%, so the average return is 10%. Standard deviation is 15%. So my question to you before we started this was, which option would investors prefer? Well, remember, we said that one way we're going to think about conceptualizing the assessment of performance in an actively managed portfolio is by taking the total return and scaling it by risk and then comparing that. Well, if you look at the green, total return is 10%, but the risk is 15%. 10 divided by 15 is 0.67 if I'm doing my math right. If you look at the red portfolio, average return is 10%, risk is 5%, so the ratio is 2. In this case, we would give the nod to the red portfolio. That manager is generating more return per unit of risk, which is what we believe investors would prefer. All right, now we can tie all this stuff together. How should we then think about calculating average returns? Because what we ultimately want to do is this. We need a measure of average returns and we need a measure of risk. And if we have that, if we have a measure of return and a measure of risk, we can start comparing portfolios and assessing what we hope is the investor acumen of the portfolio manager, with the caveat that we can never disentangle acumen from luck, but we're going to try anyways. Okay, so how should we calculate average returns to put in the numerator of that particular scaled comparison? Well, we're going to start with arithmetic average returns. This is very simple. For an asset with n return periods, and I will give you a demonstration here shortly, Step one is to simply calculate the returns in each period as follows. Take the price in that period minus the price in the previous period and divide it by the price in the previous period. So that's just the percentage change from one period to the next. Then you simply calculate the arithmetic mean of these n periods. So add up all of the returns, divide by the number of periods, and shazam, that's arithmetic average. You can then go on to calculate variance. And you would calculate variance by taking each return, subtracting out the average, square it, then add up those squared deviations and divide by the number of observations minus 1. And then you can get standard deviation as the square root of variance. Let me give you an example of this really quickly. Okay, so this is the actual price data for WAMCX from December of 2018 through December of 2019. So what I want to do is I want to calculate the return each period. So how I would do this is I would take this month's price. This is monthly data, by the way. So I'm taking, let's start that again. I'm taking the price from December of 2019, subtracting the price in November of 2019, dividing it by that price in November, that's the previous period, turn that into a percent, and there is the percentage return. And we could send this down the line, and so for the year 2019, here are the monthly returns. So we have the monthly, these are the arithmetic average returns. Then we could calculate the standard deviation by finding the deviation. By the way, there's a shorter way to do this. So first thing we want to do is get the average. So I'm going to get the average just using the Excel formula. So there's the average, 3.37%. In order to get the standard deviation, we could calculate the deviation. So let's take each observation minus the average. Okay. There's that. Then I'm going to get the squared deviation. So I'm just going to take that and multiply it by itself. So again, that's just square deviation is all we're doing there. We're going to do that all the way down the line. Okay, and then we're going to add up all of those squared deviations. Add up all the squared deviations, and then we're going to divide that by, notice that there are 12 return periods here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. We're going to divide by n minus 1. So we do that. And that gives us variance, right? So this is the sum of squared deviations. This is variance. So then to get standard deviation, we just take the square root of that. Turn that into a percent. So, all right. This is helpful. Our mean, in this case, our arithmetic average. Our arithmetic average is 3.37%, and our standard deviation is 6.638%. Standard deviation. Okay, so there's our first and second moment. Very easy. And then what we can do is we can scale, right? We could take the arithmetic average divided by the standard deviation. So we could do that. So I'm just going to do the ratio here. So the ratio is the return divided by the risk. And I'm just going to turn it into a simple number. Okay, that is arithmetic average return. Let's talk for a second. What do we like about arithmetic average returns? Well, first off, it's pretty simple. Second off, it's pretty intuitive. It's actually not that hard to describe this to friends and family and associates. We also like that it gives us the first and second moments. It gives us return, it gives us risk, and so that allows us to do this, which is awesome. It's incredible. There's a problem though. What do we not like about this? Well, it misses the effects of compounding, therefore it's flat out wrong. Let me show you what I mean. So we're going to come back over here. What I'm going to do now is I'm going to say, what if I started with $10,000? And what's going to happen is every period, I'm going to earn whatever this actual portfolio returned. Okay, so I'm going to start with 10,000, but in January of 2019, I'm going to grow it at whatever the rate of return was to the portfolio. And I'm just going to do that every month, right? So in February, I'm going to take the previous amount in January, and I'm going to grow it at 1 plus whatever the portfolio is earning. Okay, so I'm just going to do that all the way up, and I want you to see what I end with, right? We'll turn these into dollars so we can see them a little bit better. Okay, this is actually what would have happened. If I would have put $10,000 into this mutual fund, I would have ended with $14,575. Now what I'm going to do is the same thing, but instead of growing it at the rate of return that the portfolio is earning, I'm going to grow it at the arithmetic average return. Watch what happens. Okay, so in January, I'm going to take my $10,000. I'm going to grow it at 1 plus 3.37%. Same thing in February. I'm going to take the amount that I have in there at the end of January. I'm going to grow it at 1 plus this rate. And at this point, I'm just going to lock it in. And trust me that I'm just carrying this all the way forward. And you're going to see a big problem when we get up to the top here. So this is arithmetic average. Notice that the result I get from using my arithmetic average return is not what actually would have happened. This is what I mean when I say it's just wrong. And the reason for it is arithmetic average does not take into account the effects of compounding. That's what I'm getting at right here. So there's a lot to like about it, but it misses the effects of compounding, which means it's wrong. And if it's wrong, don't use it. So we can't, in good conscience, use arithmetic average. Even though it does give us the first and second moments, it's wrong. The first moment is wrong, so we have to do something different. Well, the next thing you could move to is geometric average returns. If you'll remember from basic time value of money concepts, if you have a beginning value, which we call present value, and there's a steady growth rate over a certain number of periods, then you can calculate your ending value by simply taking your present value multiplied by 1 plus your rate of return raised to the number of periods. Again, R is what we call periodic rate, and N is the number of compounding periods. Well, we can do some simple algebra here, and we can say, okay, if that's the case, then the average return can be calculated by dividing the ending value by the beginning value, raising that to 1 over the number of compounding periods, and then subtract out 1. So to obtain geometric average returns, all we're going to do is this. We're going to take the ending value of the portfolio, divide it by the beginning value, raise it to 1 over the number of compounding periods, and then subtract out 1. Let me, again, give you an example on this. Okay, so now I'm just going to calculate the geometric average returns. So what I'm going to do is I'm going to take the ending value. This is the price, the ending price. I'm going to divide it by the beginning price. You have to watch out on this. We're going to raise this to 1 over the number of compounding periods, but this is where you have to be careful. There are 13 prices, but only 12 compounding periods. There are only 12 growth periods. So we have 13 prices, but 12 compounding periods. So you want to use the number of compounding periods, not the number of prices. Okay, after that, subtract 1, turn it into a percent, Alt-H 0. Okay, great. So there is our geometric average return. We're going to do the same experiment that we did earlier for arithmetic average returns. I'm going to start with $10,000. Sorry about that. 1 second. Just got to fix it. Sorry. Okay. Okay, so again, we're gonna do the same experiment. So I'm starting with $10,000. I'm gonna grow it each month, but this time instead of growing it at the arithmetic average return, which we know gets to the wrong outcome, I'm gonna grow it by the geometric average. So I'm gonna take my starting value, multiply it by 1 plus my geometric average return. I'm gonna lock that in. I'm gonna walk this all the way up. So that's just me growing my money at 3.19% every month. Okay. I'm going to turn that into a dollar. And what I want you to see is using the geometric average rate of return, we actually get the right answer. Notice that the ending value of my portfolio is the same as what it would have actually have been if I would have invested in a WAMCX. Okay, back to the PowerPoints. So what do we like about geometric average returns? Well, it captures the effects of compounding and it's right. So that's awesome. So let's use it. But there's a problem. There's no variance or standard deviation. It's impossible to calculate variance or standard deviation using this technique. So we can't actually execute the methodology that I proposed to you earlier. So that's a problem. We have to look for an alternative, and we're going to find that alternative using continuously compounded returns. Now, I'm assuming that anyone watching this video has already done a fair amount of studying on the subject of time value of money. Remember, when it comes to time value of money, you can have different compounding frequencies. Returns can compound monthly, they can compound weekly, they can compound daily like credit cards. But you can also have theoretical continuous compounding, which means whatever you earned in the last second compounds with what you're earning in this second. If that's the case, this is the basic time value of money formula. If you start with a pile of cash, a present value lump sum, and there is a periodic rate of return that compounds continuously over n periods, then to get the ending value, you take the beginning value times E raised to the periodic rate times the number of periods. I'm going to give you an example of this in just a second. Well, again, we can do some math and we can solve for R. And R will be the natural log of the ending value over the beginning value divided by the number of periods. So what we could do, I'm going to break away at this point, and I'm going to show you how we could calculate continuously compounded returns. Okay, so if we wanted to get continuously compounded returns, now what we would do, just remind ourselves of the formulas, we would take the natural log of the ratio of the ending over the beginning and divide it by the number of compounding periods. So the natural log of the ratio of the ending value over the beginning value divided by the number of compounding periods, which again in this case is 12. Okay, do that. So what does this say? This says that based on the price data that we have here, on average, this portfolio was earning 3.14% per month if that's being compounded continuously. Okay. There is an alternative way, and by the way, the way you can check this, if you want to check it, I got to make sure I do this right. I often mess this up. But again, we're going to start with $10,000. So now what I'm going to do is I'm going to take $10,000 times E raised to the continuously compounded rate. And you multiply that by the number of periods, but in this case, it's only one period. So you do that. So what I'm doing now is this is just continuous compounding, taking the beginning value, multiplying it times E raised to my continuously compounded rate of return. If we do it right, it should get to the same number, which it did. Okay, so notice, whether we're doing geometric or continuously compounded returns, we get to the right answer. right? So they're right. That's what we like about it. But you might be sitting there saying, yeah, but hold on, you got the same problem. You did the same sort of thing. You just used the beginning and the end, and you calculated this continuously compounded return, and now there's no way to calculate standard deviation and variance. Well, I have very good news for you. There is an alternative way to do what we just did. Here is the alternative method. Every period, calculate the return thusly. Take the natural log of this month's price over the previous month's price. So we're going to define that as our periodic rate of return. So that's our monthly rate of return. Then you just take the average of all of those returns, and you will get magically the same number as what we got over here. Let me prove this to you. Okay. So what I'm going to do is I'm going to calculate continuously compounded returns using that other method. You start by calculating the return each month as the natural log of the ratio of this month's price to last month's price. Okay? Do that for all 12 months. Turn that into a percent. Then, in order to get the exact, this is almost magic, in order to get the exact same number that we got previously by calculating the continuously compounded returns, all you're going to do is take the average of those 12 months. Notice, we get the exact same answer. And because we now have 12 monthly returns, this represents a statistical mean. This is a mean, and we can also calculate standard deviation. Just like we would over here, we would use the exact same methodology, except I'm going to shortcut it now, and I'm going to use the standard deviation of a sample formula. Do that, and we now have our standard deviation. And this is what I wanted to show you in the PowerPoints. Okay, so if we use our alternative method, we can calculate a statistical mean. There's the first moment. And we can calculate variance, which gets us to our second moment. Okay, so we have a mean and a variance. Remember, to get to standard deviation is easy. You just take the square root of the variance. So this is really awesome. We have continuously compounded returns that result in a first moment and a second moment. And I've got more good news for you. If you want to annualize, it's super easy. With continuously compounded returns, the way you annualize the return is simply multiply your continuously compounded average return by the frequency. So if you're talking about continuously compounded monthly returns, to annualize it, just multiply by 12. If you're talking about continuously compounded daily returns, just multiply by the number of days in a year, which we usually estimate at 250. For variance, it's the same thing. If you have the continuously compounded variance for monthly returns, multiply by 12 and you've annualized. If it's daily variance, multiply by 250 and you've annualized. If you have standard deviation of monthly returns, continuously compounded monthly returns, multiply by the square root of 12 and you've annualized. If you have daily continuously compounded standard deviation, multiply by the square root of 250 and you've annualized. This is so simple, so simple. So what I'm telling you is, when we did WAMCX, I got an average continuously compounded monthly return of 3.14%. How would you annualize that? Simply take it and multiply it by 12, and there it is. How about the standard deviation? Simply multiply the standard deviation by the square root of 12, and you've annualized it. And there they are. We now have our mean and our standard deviation in an annualized form. If you're wondering, if you're like, wait a minute, I'm not sure that's right. Well, hold on. I've already proved to you in this column that this monthly continuously compounded return is right. If you start with $10,000, you're going to get to the exact same amount if you earn that every month and it's continuously compounded. Let me prove to you that this annual number is right. If you start with $10,000 just like we did, but now instead of earning something every month, you just earn 37.67% continuously compounded over the whole course of the year, let me show you what you get. Now it's going to be the beginning value, 10,000, times E raised to the return, and there's only 1 year here, so we just do that, and look at what you get. Shazam. So I have proven to you that this continuously compounded return right here is the same as this continuously compounded return, and they are both right. I proved it to you right there. I showed you that the way to annualize that is super easy. Just multiply the monthly continuously compounded average return by 12, and if you do that, I've showed you that that is right in this column. This is super helpful. So what we're going to do is we're going to rely on this methodology of continuously compounded returns. Why? First off, because it's right. Second off, because there's a variance and a standard deviation. In other words, using this methodology, we're using the right number, and we have the first and the second moment, which allows us to do this performance assessment that we began the presentation with. Okay. Now, what do we not like about this? To be honest, it's a little bit cryptic to interpret. You have to be able to wrap your mind around the idea of continuous compounding, and so it's kind of hard to explain to other people. Well, this leads to the punchline. We started off saying, wouldn't it be nice if we could do something like this? Take the total return of our portfolio, scale it by the amount of risk, and then compare it to other portfolios and benchmarks. This might be a first attempt at helping us investigate acumen, investor skill. And this leads to this thing called a Sharpe ratio. And forgive me, I've got a little bit of a mistake in my formula here. Pretend that the line stops right here at the return. What you do is you take the average return to a portfolio, subtract out the risk-free rate, and you divide it by the standard deviation of the portfolio. This is what we call the Sharpe ratio. Now, I'm going to ignore risk-free rate for today, but let me just give you, I'm going to try to operationalize this thing for WAMCX. So let me go back here. And by the way, now I have 10 years worth of data for WAMCX and for the S&P 500 ETF. So what I want to do is I want to calculate a few variables for each of these. I want continuously compounded average returns, but I'm just going to put average. I want the standard deviation, and then I want the ratio, and we're going to do a comparison. Okay, so the first thing we're going to do is we're just going to get the return to WAMCX. And remember, the way we're going to do this is the natural log of the ratio of this month's price divided by the previous month's price. We're going to run that all the way down. We're going to go to the bottom and delete this last one because the first price can't have a return. Okay, I'm going to copy and paste that formula over here as we do the return for SPY. So now I'm just doing the exact same thing, turning them into returns. And now we're going to calculate the average. So the average for WAMCX, and we're also going to do the average for the S&P 500. Now we're going to annualize these things as well. We might as well do that right now. Let's do this. So remember, to annualize it, it's super easy. It's just the monthly continuously compounded return times 12. So that's super easy. And you can see that over those 10 years, WAMCX really did outperform the SPY on a return-only basis. You can see that WAMCX returned 15.5, S&P was at 13. Let's calculate monthly standard deviation. So I'm going to do standard deviation of a sample. Come over here to WAMCX, highlight all of the rows, and turn this into a percent. Standard deviation then, and we're going to annualize that. Remember, the way we annualize it is multiply it by the square root of 12, since we're talking about standard deviation. And we can just copy and paste those formulas over here. All right, now, I do want to point something out, and this is the whole punchline. Remember, what we were really wanting to get to was this thing right here. I want to take the return and scale it by risk, because we don't know how much of the total returns is risk versus risk-free rate versus acumen versus luck. But this scaled measure can help us start to get at that. So let's do our ratio, and we'll do it on an annual basis. So I'm going to take my annual return divided by my standard deviation, and I'm going to turn it into a simple integer format. Okay, and this is really fascinating, and this is exactly the punchline I wanted you to see. Make that a little bit bigger. When we actually do this thing, when we take total returns and scale it by risk, and by the way, this is really important for me to tell you, standard deviation is just one way to think about risk. We're at the very beginning here. We're going to dive a lot deeper in subsequent lectures and videos, but for now, we're just defining risk as dispersion around the midpoint, volatility. This is how we talk about this, volatility. When I do that, it turns out that the S&P 500, or the S&P 500 index, I should say, the ETF, the S&P 500 ETF actually gets a lot more return for every unit of risk. What does that tell us? If we were trying to actually do a decomposition, one preliminary conclusion we would come to is that a much higher fraction of these total returns to WAMCX are coming from risk, not necessarily investor acumen. And that's important, especially if you're trying to assess your own performance as a portfolio manager. But especially imagine that it's your job to actually go out and identify top managers. Imagine that you manage a fund of funds. So you have a hedge fund that invests in other hedge funds. Well, you would want to be able to tease out acumen from risk-free rate, from luck. And this is one helpful tool. Again, we're going to call it the Sharpe ratio. Let's call that good for today. I hope this was helpful.